Professor Beanstalk coming back with another lesson in our Investing 101 course. Last time we covered the basics of dividend investing, and today we're answering 5 basic questions you might be embarrassed to ask, but you should probably know the answers to. Really, they're just questions I've had myself. Because investing can be kind of confusing. And of course we'll get people saying, "But Nick, people could just Google all these answers. Why are you making this pointless video?" But a wise old sensei once said, if you don't know the question, you'll never find the answer. Let's get into it. Question 1. Can I lose more than my investment? Short answer, no. Unless you're trading options or on margin, but that's a topic for another day. We're talking straight up, if I invest $100 into a company, can I lose more than that $100 that I invested? Long answer, still no. Again, for the main type of investing that I do, which is for the long term, if I invest $100, all I can really lose is that $100. Let's say you take that $100 and want to invest in Hamster Hats Incorporated because you heard some guy on the internet say that they were going to skyrocket, which we all know you would never take advice from strangers on the internet, but just for an example. Unfortunately, the market isn't doing so hot for them. Who would have guessed? So you watch their stock price slowly go down, red day after red day. But you believe in them and think they can turn it around, so you don't sell your position and just continue holding on to it. But eventually it goes all the way down to zero. So you might ask, but most companies have some sort of debt. Am I obligated as a shareholder to pay those? Thankfully, no. They're not going to come after you and your other assets as a common shareholder, so don't expect a bill in the mail from them. You'll just lose that initial $100 that you invested. And maybe next time you'll do a little more due diligence and realize that a hamster hat company isn't sustainable. Question 2. What is dollar cost averaging? I mentioned this a lot, so what the heck is it? Dollar cost averaging is the concept of investing the same amount of money into the market regardless of what the price is doing. Say you have $25 to invest every single week. You're going to buy on the green days when the price is high. You're going to buy on the red days when the price is low. You're just going to keep buying. Just keep buying. Just keep buying. This really helps you not worry about what the market is doing on a day-to-day basis. You don't care about the news reports that say the market is at an all-time high and due for a crash, because you're in it for the long term and you're going to be buying anyway. When you're buying at the highs and buying at the lows, you end up with a pretty average cost and much better off than trying to time the market. You may have heard this example before, so I'll keep it brief. We have 3 people who all save $200 per paycheck for 41 years, totaling $99,000. They all invest into the stock market, and when they're not investing, they're saving their money at a 3% interest rate. But they all have different investing strategies. Our first person has the worst timing in the world and invests at the all-time highs. What a shame. Our second is a stock market genius and correctly predicts the bottom of the market and invests then. That's amazing! And our third just dollar cost averaged into the market over the course of their investing career. That's boring. So who do you think has the most money after those 41 years? My first guess would probably be the person that could correctly predict the bottom of the market. But here's how it panned out. Our first investor with the worst timing ends up with $773,358. Really not that bad considering their luck. Our second, who has the best timing, has $1,123,573. Pretty impressive nest egg. But our last investor, who just dollar cost averaged, has $1,620,708. Point being, just dollar cost average into the market. Don't make it harder than it needs to be. I'll leave a link in the description for the full example. Our third question today is, what is the difference between a stock and a share? I pretty much use them interchangeably, but there is a difference. Kind of. I love my food examples, so we're going to use one here. Say we're going to bake a pie, a nice blueberry pie. Imagine your pie is like your stock, but you can cut that pie into 6 slices or shares. So you have one stock, but 6 slices or shares. Pretty simple. Bringing it back into the real world, our stock is our company, and you can own pieces of that company through the stock market in the form of shares. So right now, I own 4.22 shares of Apple's stock. Question 4. What does this chart mean? This is called a candlestick chart. And really, it's just showing what a stock's price is doing over a certain period of time. You'll see it on any investment platform, and there's just a few data points to know so you can understand what it's saying. Let's take a look at Nikola, for example, because they've been in the news a lot, so their stock must be good, right? Each line represents a 10-minute window throughout the trading day and what the stock's price did during that time frame. If the line is green, that means the price was higher at the end of that 10 minutes than it was at the beginning of that 10 minutes. Let's take a look at Nikola here. They have this nice little green line right at the beginning of the day from 7:30 to 7:40 a.m. On any brokerage or platform, you can tap, you can click at any point on the chart just to see what the price did. So if we hold our finger on Robinhood, it says it opened at $32.99 and closed at $34.17. So again, the price was higher at 7:40 than it was at 7:30. So we get a nice little green line. When the line is red, that means the price was lower at the end of that 10 minutes than it was at the beginning of that 10 minutes. Towards the end of this day for Nikola, they had a nice long red line here from 2 o'clock to 2:10 p.m. So again, you can see that it opened at $32.80, but it closed $1 lower at $31.80. So we get a nice little red line. Again, on any brokerage or platform, you can tap or click on the chart to get all this information, what it opened at, what it closed at, what the high was, what the low was, and how many shares were traded during that time frame. Or if you want to keep it simple, you can just flip over to this basic line graph to see what the price is doing. But the candlestick chart gives you a little more information. Our fifth and final question of the day is, how are ETF expense ratios charged? I've mentioned some of the ETFs I invest in before, as well as their expense ratios, which again is just the fee the company charges to manage and keep track of whatever they're keeping track of. So when they buy or sell companies, someone has to do that, so that's what that fee covers. But how do they charge it? Do you get a bill in the mail every year? Do you see a little charge from your brokerage, or do they just take some of your uninvested cash? None of that. It's kind of just baked into the stock's price. For example, say you invest $1,000 into an ETF with an expense ratio of 0.75%. Let's say the fund didn't do so hot one year and they returned 0% on the stock price. So you'd see your $1,000 go down to $992.50. So again, you wouldn't get a charge or anything like that. You just lose a little bit of money from the fee. This is why it's so important to pick a good fund with a low expense ratio, so even if the market isn't doing so hot, you don't lose out on more than you have to. So what other questions are really basic but everyone needs to know that we can continue to cover in our Investing 101 course? Like, why has everyone not YouTube mumbo jumbo that subscribe button, that like button, and that bell notification? If you don't do that, you're gonna get an F. I kept it to 5 questions so this video didn't go too long, even though it still kind of did. But once I gather a handful of more, I'll make another video. Maybe we can make another series out of it. 5 questions with financial beanstalk. Fuck-a-whoop. Doesn't flow off the tongue as well as sipdig. Thanks for watching, I hope you learned something, and let's continue to climb this beanstalk. Say you're gonna bake a pie. We'll pick blueberry today. Imagine that your pie is your stock.
Here's some information about today. A daily live broadcast provides current domestic and international news, weather reports, and interviews with newsmakers from the worlds of politics, business, media, and...
So Syria on my computer's listening to me.